Welcome, everybody, to another edition of our Mosaic podcast. Thank you so much for joining us. My name is Mandisa Zavala, the head of asset allocation at Alexforbes, and I'm joined by the beautiful Mpho Piane, our chief economist.
Thank
Hello,
you. Hi,
Mpho.
Mandisa.
Happy August, Women's Month.
Oh, yes, it's always
I
month.
know.
Yeah. No wonder the weather is,
Yeah,
improving.
something is happening in the
We are
environment,
blooming. We are
right? I get
blooming.
that. I
Yeah,
get that as
yeah,
well.
yeah, yeah.
Sure,
No wonder
but
you're glowing.
oh,
I can see the Women's Month glow.
thank you so much. I'm very happy to actually start the podcast today with maybe news other than updates on the war. But yeah, it's been definitely an interesting month. I want to start things off this time. I know we always start off with the economics overview and then we go into what markets did. But there's a couple of things that I have a little bit of an issue this month, and I need you to help me with it, if you will.
Yeah.
So definitely quite topical, I think, for the month of July was the Fed having to sit down and pencil in their is it a rate hike, is it a hold type of view. We had some ongoing debates around will they not, because of issues around the war. And I think the last time that we sat on this in this beautiful room, we had actually identified that some of these risks around high inflation were dissipating. So it was becoming more and more consensus that the Fed would hold. But of course, it was going to be important to also watch the dynamics, because after that, we actually saw some of the risks around the war, pick up again. And we unfortunately had another run-in with the US-Iran war. Yeah. So when the Fed came to the market, and in particular Kevin Wash, some of the dynamics were quite interesting to observe. I think one of the things on my side, and we sort of played around and joked about this at the last podcast, to say he's making us do our homework. I think that's exactly what you said in particular, to say, there's definitely not a lot of talk that's coming through from him as much as we've become accustomed to from the other Fed heads. And one of the things that was interesting in this particular thing is the fact that in our update, in our quarterly market update, one of the factors that we had identified as problematic for us was that we were most likely entering into a period where maybe communication from the Fed was going to be far less. And we had identified that as some form of signal that perhaps volatility might be on the higher side. And I think we sort of saw something like that play out, because leading up to the decision, we had already seen definitely an elevated yield environment, because as there was a reflation within the war, we did see yield markets responding, and so you could see leading up to the discussion that there was a question mark around, will the Fed look at this and think maybe we need to hike, or will they actually signal towards maybe even needing to do, if a hike is needed, we will do it. And I think that the second part is quite important. Yeah. I think what became frustrating is the fact that the rhetoric that you get from, in particular, Kevin Wash, and the decision sometimes seems a little bit disjointed from my side. And I need you to help us here, because the frustration on our side, especially as bond investors, we want stability. We want you to say, lead us into a particular pathway and be stable about it. We don't want you to chop and change. I think one of the things that we had noted was, the market started to price him being very dovish when he came to the into the scene. Mm-hmm. And then after that, they had to sort of pare that away to say, oh, actually he is concerned about inflation. Mm-hmm. And then we were found again having to contend with those dynamics again. And you saw bonds as well, the bond market reacting in a way of uncertainty. Now, my question to you, very long-winded way, is help us understand essentially what you thought of this. We do think differently, because you are an economist and you think with the mind of an economist. I think with the mind of an investor in equities as well as bonds, and what, I benefit from certainty, where else maybe, like he argued, there's actually reason for them to be a bit more independent. And so there's those dynamics that I just want to unpack with you, just to get your view on this month that was really a central banker kind of month.
Yeah. Thanks for that context, Mandisa. I mean, July was quite an interesting month. I mean, just firstly, when we said early July, when we were recording, the June podcast, it was, a different environment, right? Like all had, was back at pre-war levels. It looked like we were out of the woods yet. We talked about how, we're starting the second half of the year on a much better footing. But, as you correctly pointed out, like that situation quickly unraveled given the re-escalation in the Middle East conflict. But I think, what was perhaps more interesting and, welcome relief, to be honest, from the, war headlines. For me, monetary policy became interesting again during July, right? Like, yes, we, had a bit of a market meltdown, both globally and locally. But that, for me, made monetary policy interesting again. And, to just get back into, your question, I mean, going into the meeting, the Fed's decision to hold, firstly, it was not... Yes, it was a bit of a surprise, but it was not a surprise for analysts. So like when we look at consensus, I think most analysts were expecting that the Fed is going to hold, but the market had priced in a 30% probability of a hike, right? So that's the one aspect. But, yes, we did see that actually reflected in the split vote. But for the most part, it was the conference that, was more interesting, right? And there's several things that came out from the conference. So, for me, the market meltdown was attributed, firstly to, Kevin Walsh. During his first conference, he came out guns blazing at the June meeting, right? He came out guns blazing. The Fed is going to deliver on price stability. Inflation has been above target, over the past 5 years. So the Fed remains committed to price stability, and they're going to deliver on that, right? And then he walked back that forward guidance and, said, the market is going to have to do its homework, give us signals. And the market did exactly that, right? So, when you look at the inflation outlook, you look at the labor market outlook, because the Fed is attentive to both sides of its mandate, right? And you just look at a simple policy rule, like your Taylor rule, for instance, right? It will tell you that where inflation is relative to the target, and given the stability in the labor market, the Fed needs to hike. Like, it will tell you that, right? But when you look at historically as well, it also shows you that the Fed does not hike to the same extent that the policy rule suggests, right? And over the past couple of years, there's been that forward guidance to say that, yes, we're going to be hiking or not, we're going to be hiking, we're going to be on hold. But I think what made it difficult this time around was the lack of forward guidance that we saw from Kevin Walsh. And, in isolation, taking his words that they're going to deliver on price stability and, prompting the market to give it guidance. And the market did give guidance to say that, the Fed needs to be hiking. The problem came in during the Q&A, where it seemed as if though Kevin Walsh was walking back some of that hawkishness, right? But, my assessment is that what Kevin Walsh said, for the most part, was not unorthodox. So firstly, he talked about that, the market was concerned whether the Fed is going to deliver on hikes in order to deliver on price stability, right? So that was the first issue. And what caused that issue is that he mentioned that interest rates are one of the many policy tools that a central bank has at its disposal to deliver on price stability. And the Fed is still assessing its toolbox, essentially, to decide which tool they're going to use. He again referenced the balance sheet, which we've talked about at length, at this podcast, that it's one of the things that he's talked about as contributing to inflationary pressures. So he mentioned that again. The market then, had another meltdown when he talked about, given that the market has went ahead, priced in, interest rate hikes, financial conditions have tightened. So, in that respect, the market has done the heavy lifting for the Fed already.
Market has not done
I don't think the
that
market
much.
I don't think the market was also ready for that,
Exactly.
right? But essentially, talking down inflation, which then drives tighter financial condition is one of the tools that central banks use. It's just that, I guess the way it was communicated or, how it was also came as a surprise to the market, because I don't think the Fed has been that explicit about that particular mechanism
100%.
before, right?
We've not experienced that before.
Yeah. But I think where the wheels really came off for the market, the straw that broke the camel's back was when he then opened the door to how inflation could be calculated going forward, right? That raised a lot of questions. He talked about, he continued to reiterate price stability. But then he then mentioned that one of the task forces are actually looking into, data, the way inflation data is collected, the way inflation is calculated, right? That raised a lot of red flags for market participants, because it, suggested that the headline inflation indicator that the Fed use could change. They could come with, another measure in the future, which is not reflective of underlying inflationary pressures. And I think that's where the biggest concern is that if the Fed now introduces another measure that is not truly reflective of underlying inflationary pressures, then it in fact is not delivering on price stability.
And I mean, I want to say as well, very good point that you've made there, because the concern is not that you're going to enhance the process. Of course, we want you to enhance the process. There's already so much uncertainty, and we've talked about this at length. It's just question mark around, is this the right time for you to be pitching, like a new thing that you want to, introduce when there's already so much uncertainty? And really what the market is just asking one question: are you prepared to move? I think, and we mentioned it earlier to say, this is a new central. This is like he's having this role for the first time in essence, and so we're still trying to figure him out. I think had we known him, it might have been easy to sort of understand the in between as well. And so the point that you're raising around some things that maybe might seem as they are good, that are starting to be read as, okay, but, is that really good? Is because we don't necessarily know whether that means, is this a good thing in the long term? Does this mean lower inflation or does this mean high inflation? Because it could mean, and I think that's to your point, it could mean either. It doesn't necessarily mean that they're going to tolerate high inflation. It could also mean that maybe inflation, they're going to target lower inflation going forward.
The other point also that you raised around, the key question is, if it comes to time that the Fed has to deliver hikes, will they deliver hikes, right? And for me, looking at the press conference and having followed Kevin Walsh for the past couple of weeks, I don't think he ruled out interest rate hikes altogether. I think what he mentioned was that interest rates are one of the many policy tools that are at the disposal of the Fed. And if anything, they're still exploring all the toolbox, like the full suite of toolbox that they have at their disposal. One being, the balance sheet. I think what perhaps he was trying to say was that, give us more time as we're trying to assess what is the best tool to use in this environment. And I think that, it got mixed. Yes, as you indicated, he's a new Fed chair. We're still getting to know him. We're still getting to understand him. And I think what's unfortunate really is the lack of that forward guidance. So for me, I mean, to just wrap up that discussion is it has become, the market versus the Fed, or market versus Kevin Walsh. The market continues to price in, interest rate increases. Are they going to force his hand to deliver on those interest rate increases? Or is he actually going to walk back his forward guidance stuff? Or rather his forward guidance stance, right? And now start, guiding the market lower in terms of what the policy direction is, right? So it's for me, it's one of those two. But also,
I think they must get you as the chief communicator.
You think so?
Yeah. I think Kevin Walsh, if you're watching this podcast, as I know you might be, we have your chief communicator.
But also centrally to this discussion is the inflation outlook, right? So there's a lot of uncertainty around the inflation outlook because, we continue to have this on and off Middle East conflict. But I think what's also important is that, oil prices, they are down relative to the peaks that we saw in March and April, right? Despite the recent re-escalation, oil prices are lower. So that should contribute to some, disinflationary trend in the data. But I think what's even more encouraging for us is that when you look at underlying inflationary pressures in the US, we also started to see some disinflation in housing cost in particular, which have a weight of about 28%, yes. Right? So if we continue to see that disinflation, that could be another thing that actually saves the Fed, and they stay on hold if we continue to see that credible disinflation trend. The biggest risk for the market is a more aggressive re-escalation in the Middle East conflict, which sends oil prices even higher, and essentially could lead to a much more aggressive monetary policy tightening cycle, right? So if we look at other central banks as well, the Fed is not the only one that is, navigating this uncertainty posed by the Middle East conflict. As I indicated, it was not only the Fed that met in July, we also had the ECB, the BOE, as well as the Bank of Japan, and all decided to keep policy rates on hold. But the Bank of Japan, we know they continue to normalize policy rates. So, expectations are that they will continue hiking. The ECB and the BOE as well indicated that if inflationary pressures persist, they, are going to have to hike. The ECB had hiked already. So that will be a continuation of the, mild mid-cycle adjustment hiking. Whereas with the BOE, they're more concerned about second round effects. And what they've indicated is that if we see persistently higher energy prices that lead to stronger second round effects, then monetary policy is also going to have to adjust. So, quite an interesting month. I mean, I definitely was, welcomed the distraction from, the Middle East on and off Middle East conflict. But I'd be very much interested to see how, the market, it was quite a volatile month, yeah. All prices moving from 70 again to like 100. And, today I think we're sitting at like 85, and then monetary policy dominating the discussion as well. Some sell-off in semiconductor stocks.
Yes.
It was an eventful month. So,
definitely.
Would really like to hear your thoughts on that and, what you're looking at going forward.
No, 100%. It was definitely a month where there was quite a bit of activity on the market. As we preempted the conversation, we did step away immediately after we step away from the podcast.
We jinxed it. The way we were so happy.
I think we were a little too happy. We were a little too happy, and we need to calm ourselves down from here on forth. But yeah, unfortunately, we did get that re-escalation again in the war. And there've been quite a number of theories that have come out around a particular oil price now that, a range that you're now looking at just because of the geopolitical risks between Iran and the US. And, that sits more around your 80s to your 90s. Some are even going towards your 100. But nonetheless, that did cause huge wobbles in the stock market. And naturally, where you find investors taking a lot of profits when such things happen is within the sectors that have the regions and sectors that have done well. And so if I just look at our emerging market universe and what we track, we saw that some of the biggest declines were actually experienced just in the month of July alone in South Korea. And if you remember that was very, very high. South Korea, I think at the time when we sat, it was over 100 in return just on a year-to-date basis. Yeah. The year-to-date return now sits at around closer to about your 80. Mm-hmm. So it actually dipped by a lot, close to 20%. It lost quite a lot of value, but we saw some flows going out of that. It was also because of the issues that you point out around semis. We did identify that as a risk to say there's quite a lot of good news that's been priced into this AI trade. So if there's any little miss, it doesn't even have to be major. It doesn't even have to be the company's shutting down. Yeah. Nvidia's closing down and they're firing everyone. It just has to be a miss from the market expecting earnings to come in at 10.6 and they deliver 10.4. That becomes massive for a market that is already really perfectly priced, or you could even argue where there's some sort of sugar rush. The way that we would look at these types of dips is not in a bad light for us, because we would say this is actually the perfect time for you to buy, because it was also as a result, there were some exogenous factors, but there were also some endogenous factors. The endogenous factors were because of some misses in earnings, but the exogenous factors were because the market was trying to calibrate. Are we back to, the war, when the war started? Is the oil price going to go back up again? Are we needing to price in the risk of, a high inflation spike? So all those things were what the market was contending with. But at the end of the day, we didn't actually have a very bad month. I think we still ended up with positive returns from a developed market perspective. Even the US was more or less about flat. It wasn't necessarily on the negative side. I know some, depending on the currency that you're looking at, it would have maybe been minus 0.1 in US dollars, or maybe it might have been slightly less if you're looking at it in another foreign currency. But nothing to sort of flag on that side. I think from an outlook perspective, as we go forward, we are comforted by the comments that you made with regards to, there is work that's being done within the Federal Reserve. And I'm laughing because we always have conversations prior to this, and sometimes they're a little bit more spirited. And I am definitely not having my greatest time with Kevin Walsh, but we'll come to terms. We'll be friends soon. Yeah. And I think if we do see a much more a continued accommodative environment, that will be great for equities. But where there's definitely going to be concerns, it will be around bond yields. I mean, bond yields almost hit 5%. They were up to 4.7%. And that is already very extreme. If you just think about the last couple, just prior to 2020, you wouldn't have even thought that you'd pick up a US bond and get 4% or anything close to 5%. So those types of signals are very difficult to ignore. As much as, yes, we can still continue and say, we still want to be risk on, you also want to be cautious, because there's a signal that the bond investors are sending, and typically they tend to be on the right side of that signal. So you do want, the Fed to pay attention to those types of signals, but also just, like you said, speak to the market, or speak them down, or whatever the case is, but speak to those areas of concerns, because essentially these are investors that are buying your bonds, and they're either going to price in more risk, which is going to actually be far more worse for you, or they're going to go the other way, which is what you want, especially if you're going to be increasing a lot of your debt over the next coming years. So I think it's a little bit of conundrum that we're going to have to deal with. It's one of the risks that we had identified, not anything as major as another re-escalation in the war, but definitely something to take into account. So I think global, definitely some form of coming down from the momentum that we had seen, but nothing that is concerning of us that's starting to brew. I think we still think there's still some juice left within the AI trade, even within the emerging market trade as well.
Right. No, I like that. I mean, I think it's pretty much consistent with the macroeconomic picture, especially on the growth front, that we, still seeing some resilience. Yes, the pace of growth is slowing, but it's not yet crashing. And as you indicated, the biggest risk is around Middle East, which could lead to a much more aggressive monetary policy tightening. So, that continues to be the greatest risk that we are all watching. And unfortunately, nobody knows, to be honest. I don't even know if Donald Trump knows.
No one knows.
Anyway, shifting the discussion locally, again, another interesting month, monetary policy in focus, with the sub also surprising the market, oddly. So, from a central bank point of view or monetary policy point of view, it was a month of surprises. I think locally, so for me, how I make sense of the sub decision because on the day when they announce a hold, like literally I remember texting my team to say I'm shocked, because I really was shocked. Like I was so sure. And like before the announcement, I had done some media interviews, and I was literally on record saying, one of the questions I was asked was that, what would happen if they hold? And I was, with my chest, I would be very surprised if they hold.
Oh
And
my
yes,
God.
I was very surprised, right? But I think, the way that I made sense of it, of the decision, is that when the sub met in July, they were where most of us were at the beginning of July. And you'd recall when we were recording the June podcast, given where all prices were, I mean, they were back to pre-war levels. They had,
heading towards 60,
come down like significantly, right? And that disinflation trend that we were expecting in the back of that, I recall even saying that, our conviction around a rate hike at the July meeting has reduced. It's 50-50 at that point. And I think that's where the sub was when they've said in the July meeting. Unfortunately, by the time we said, most of us had moved on from, that aggressive disinflation trend. And that is because we had seen the re-escalation as, we've discussed already. But in addition to that, we had that hotter than expected inflation print, right, with CPI coming out at a 5% handle, right, which was way higher than what the market was expecting at the time. And yes, it was due to the delayed pass-through from higher transport prices. But the problem is that when you then also looked at overall services inflation, like rental cost, they're increasing. And, that's a very problematic environment for the sub, because if your services inflation is at 5% and above, and you're targeting 3% inflation, how are you going to get to 3% inflation, right? Especially in the context of continued re-escalation in the Middle East conflict, which means that you're going to continue to see that headline fuel inflationary pressures, essentially. So that was problematic. And given how hawkish the sub has been previously, they've had quite a hawkish reaction function. And hence, most analysts, by the time they said at the July meeting, were expecting that they're going to hike. But, they surprised us. And, they're not necessarily wrong, right? Because that monetary policy reaction function is being driven by the uncertainty with regards to the Middle East conflict. If we again get back to the memorandum of understanding, we see ships flowing through the Strait of Hormuz again, oil prices could fall back as quickly as they have risen, which then reinforces that disinflationary trend, right? So hence the uncertainty, and hence maybe they gave themselves time to pause and reassess the situation. But even with the disinflation and relatively lower oil prices, if you look at the inflation outlook, it continues to show inflation remaining above 4%, right? Above the tolerance level that the sub is talking about. And for us, that is problematic. And unless you see prices falling drastically back below 70, they may have to hike at the September meeting again, because it does seem as if though they're somewhat behind the curve now. But, that uncertainty continues to certainly play out in the monetary policy outlook, unfortunately.
So essentially, they've just pushed out a hike that they were going to do, in essence, and given themselves that break for some sort of, if there is some surprise, that gives them a bit of comfort. I mean, that makes sense. We can make sense of it in hindsight.
And in hindsight, right? And it's also not too different from what we saw from 100%. Other central banks. Like if you look at the ECB, they hiked in June, held policy rates in July, but continue to indicate that if inflationary pressures persist, they're going to have to do more. And I think similarly with the sub, it's just that, as you were going through the statement, like for me, that was very problematic. As I was listening to the statement, it was services inflation is problematic, risk to the inflation outlook are to the upside. And on that basis, we decided to hold. Like, what do you mean? Make it make sense. So, I think the communication there around why they held was not immediately clear from the statement. But when you assess the whole decision in the greater context of the on and off Middle East conflict, it does make sense.
Yeah. And I think for on the market side, the biggest question mark that we had after the surprise was whether this would derail the bond outlook, because in essence, we were concerned around, does this deter bond investors? Do they become more concerned around inflation actually being more problematic than what was? Because I think we've all become accustomed to a rather hawkish SARB, let's be honest. Like, I think we've just been trained quite well to the point where...
I was worried about, what they did with the governor. I was like, this is not him.
It's not the one we know. It's not the governor we know. And I mean, I was even saying that even when we joined the post-investor call, I felt like economists were actually... upset that they didn't hike. And I'm like, guys, remember, we're also consumers as well. So from a consumer side, it's a good thing. But from an academic side, okay, I see where the debate is. But I think that was my thinking as well, to say, do we actually see some derailment that's going to happen? I think we've seen a lot coming through from SA bonds since last year because of the lower inflation target. And so that has definitely presented yields with an opportunity to come down. But obviously with the Middle East war and everything that's happened thus far, we've actually seen the curve move on the other way, where we're actually seeing, the curve go higher than it coming on the lower end. And when I looked at the numbers, actually, today, I was surprised because SA bonds were down for the month by 1.4%. But interestingly, net non-SA bond flows were actually positive. They were up for the month of July. Part of this might be that perhaps they were up because they were anticipating that the SARB would actually hike. And maybe after that, we did see some losses, but the net on effect was actually still positive. And I think that for me, there was a question in the post-investor call, and someone made a comment around, is credibility, someone spoke about credibility, which a bit of a rude question, but they were talking about the market losing credibility because the rand was weakening. And I thought, actually, the numbers don't necessarily present that. Obviously, the rand has its own dynamics. Yes, the SARB decision is important there. But if you look at bond flows, I think that actually speaks to credibility more than you would, because currency has many other factors that determine it as well. And so the decline in SA bonds was not that much. If you'll remember, for those that are listening, we did actually go overweight SA ILBs. And one of the reasons why we did that is because we were seeing, as you mentioned, inflation on the higher side, and we felt that inflation expectations would need to adjust on the higher end. And naturally, SA ILBs tend to do well in that environment. And this actually turned out to be one of the best calls so far. And I don't know if you know, Paul, we need to get our flowers for this, as the kids say, but that actually has become, the second best performing asset class. It was up 5%, just below SA property. But it has outperformed SA flexible bonds and even SA cash. And I remember at the time there was a bit of concern around, but yields will still go higher, and that will impact, ILBs. But I think this has actually done well, and even overall emerging market bonds are still high, are still up when you look at them from a rand perspective. So market-wise, I think there wasn't much of, I would say, from the signals that I'm reading, there doesn't seem much of a concern on SARB credibility going forward. I think we all sort of understand that it was a pause, not an end to the rate hiking cycle. And we understood the decision in those, post-investor meetings. And perhaps, like you said, the statement was a little bit on the incomplete side. But you sort of understand that, okay, I guess there was a little bit of a level of them trying to be more prudent going forward. So yeah, we still expect, healthy returns from these asset classes going forward. I think other than that, I think we are overall a little bit more bullish on the offshore side for our SA portfolios than we are on the local side. But that doesn't mean we don't see any returns on the local side. I think there's still quite a lot of healthy things that could still come through even as we go into the year.
All right. Okay. Interesting. And I think we can wrap it there for this month. Great discussion.
Thank you.
And thanks for joining us. Next time. Cheers.
Take care.